Over 900 days have passed since ChatGPT first exploded onto the scene, igniting a global gold rush for artificial intelligence. What started as an exciting but costly gamble has now crossed a critical threshold. AI is no longer just a futuristic buzzword or a cash-burning experiment. It's becoming a major profit engine for the world's biggest tech giants. Companies like Google, Microsoft, and Meta are no longer simply pouring billions into research and infrastructure. They are starting to earn real money from their AI investments. This shift from hype to hard revenue marks a new phase in the AI revolution, where the promise of transformative technology meets the reality of business models and market returns. Take a look at Alphabet, Google's parent company, which just reported a whopping $96.43 billion in revenue, up nearly 14%, driven by AI-powered search and services. Its net income jumped almost 20%, with Gemini AI boasting 450 million monthly active users and over 2 billion users interacting with AI features daily. These numbers show AI is rapidly becoming as monetizable as classic search engines. Microsoft is riding the AI wave just as strongly. Its revenue surged 18%, with the Intelligent Cloud division soaring 26%. Microsoft 365 users are seeing smart new AI-powered features that boost productivity and justify higher subscription values. With over 100 million monthly active users of Copilot, Microsoft's AI assistant, the company's shift to AI as a service is gaining serious traction. Meta is no slouch either. The social media giant's revenue jumped 22%, and profits exploded 36%, buoyed by AI-driven ad efficiency and a massive user base engaging with Meta AI. This is helping Meta capture more small and medium business advertisers who value precision targeting powered by machine learning. But the AI story isn't just about profits. It's also about massive investment. Google, Microsoft, Meta, and even Elon Musk's ventures like OpenAI are in a fierce arms race to build out the computing power and talent needed to stay ahead. Google's CapEx skyrocketed 70% in one quarter. Microsoft plans to spend over $30 billion in the next fiscal year on AI infrastructure, and Meta's investments are expected to top $66 billion in 2025 alone. The stakes couldn't be higher. CEOs warn that missing this AI wave could mean losing a decade or more of growth and innovation. At the same time, some players like Amazon's AWS are struggling to keep up, risking losing ground in the cloud AI arms race. Finally, the entry cost for competing in AI is soaring beyond what most companies can afford. With big tech giants set to spend hundreds of billions in the coming years, the winner takes most dynamic is sharpening. The companies with the deepest pockets and biggest data centers will dominate. In this video, we'll break down how AI's massive investments are turning into real profits, explore the growing arms race, and reveal who's leading and who risks getting left behind. The AI gold rush is no longer just about innovation, it's about winning the future. In this first slide, we focus on the most important fact that has emerged over the past year. AI is no longer just a massive investment or futuristic vision. It's already generating significant revenue and profit for big tech. Let's start with Alphabet, Google's parent company. In the latest quarter, Alphabet posted revenue of $96.43 billion, up nearly 14% compared to the previous year. Even more impressive, their net income soared 19.4% to $28.2 billion. These aren't small numbers. They represent a tech titan continuing to dominate the digital economy. A big driver behind this growth is Google's AI initiatives. The company's Gemini AI platform now boasts 450 million monthly active users. That's nearly 1 in every 17 people on the planet using this AI-powered tool regularly. Moreover, Google reported that its AI-powered overviews and features across search and other services are now reaching over 2 billion users daily. This scale rivals the classic Google search product, proving that AI has transitioned from an experimental feature into a mainstream, monetizable service. That means users aren't just curious about AI, they are actively engaging with it every day, and advertisers and businesses are benefiting from improved targeting and efficiencies. Moving on to Microsoft, they've also seen remarkable growth driven by AI. Their total revenue rose 18% to $76.44 billion, led by a 26% surge in intelligent cloud revenue to nearly $30 billion. This growth is powered by AI-powered cloud services, including Azure and the popular Microsoft 365 productivity suite. Notably, Microsoft's Copilot AI assistant has exceeded 100 million monthly active users, showing strong adoption of AI tools among both businesses and consumers. Microsoft's AI enhancements have driven up revenue per user in their subscription products, signaling that customers are willing to pay more for AI-powered productivity gains. This is a clear sign that AI is translating directly into dollars, not just hype. Meta, the company formerly known as Facebook, reported an impressive 22% jump in revenue to $47.52 billion and an eye-popping 36% increase in net profit to $18.34 billion. The company's operating margin is now a strong 43%, reflecting efficiency gains partly fueled by AI-driven advertising improvements. Meta AI now reaches over 1 billion users worldwide, making it a central part of the social media experience. AI is helping Meta's platform deliver better ad targeting and engagement, which has attracted a surge of small and medium business advertisers looking for high ROI on their budgets. In summary, the data clearly shows that AI is transforming big tech's business models. It's boosting user engagement, enhancing product value, improving ad targeting, and most importantly, driving massive new revenue streams and profits. This slide sets the foundation for the rest of our discussion by proving that the AI gold rush is no longer a theoretical investment. It is a profitable reality. The race is on, and the leaders are already cashing in. After establishing that AI is already driving substantial profits, this slide dives into the massive capital expenditures, CapEx, fueling the AI revolution. The numbers reveal how aggressively big tech companies are investing in AI infrastructure, computing power, and talent, all to maintain and expand their leadership in this highly competitive market. Starting with Google, the company reported a jaw-dropping $22.45 billion in capital expenditures during Q2 alone, a stunning 70% increase year over year. This massive spending spree reflects Google's push to build more data centers and advanced computing facilities capable of supporting their AI services. Google also raised its full-year CapEx guidance to $85 billion, signaling a long-term commitment to being the backbone of AI infrastructure worldwide. Despite this, Google still describes itself as undersupplied on compute resources, a clear indication that the demand for AI hardware and processing power continues to surge faster than supply can keep up. Microsoft is similarly ramping up its investments. For the fiscal year 2026 Q1, Microsoft forecasts CapEx exceeding $30 billion, marking a 50% increase year over year. Much of this spending goes toward expanding Azure's AI and cloud infrastructure, ensuring Microsoft remains a top player in AI as a service offerings. Their investment in AI isn't just hardware, it's also about talent and software development, combining cloud scale with cutting-edge AI capabilities. Meta is investing even more aggressively. The company is expected to spend between $66 billion and $72 billion in capital expenditures in 2025 alone. Meta's investment focus is on building world-class AI infrastructure and winning the intense global competition for AI talent. The scale of this spending underscores the importance Meta places on AI for its future growth, spanning from social media to the metaverse. Elon Musk's ventures are also part of the AI arms race. OpenAI, backed by Musk and others, plans to expand its GPU fleet to 1 million GPUs by the end of the year, an astronomical number that will power advanced AI training and inference. Musk has even announced plans to build toward 50 million H100 equivalent chips within 5 years, showcasing the scale at which some players are preparing to operate. All these figures highlight a fundamental truth. The AI arms race is not about incremental upgrades. It's a massive, capital-intensive sprint to build the infrastructure, data centers, and specialized hardware that will power the next decade of technology. This CapEx explosion comes with enormous costs and risks, but it also reflects the urgent need to stay ahead. Missing this investment wave could mean falling behind permanently in AI capabilities, market share, and innovation. In this slide, we see the battle lines drawn in dollars and data centers, setting the stage for who will dominate AI infrastructure and services in the years to come. With massive profits and huge investments powering AI growth, the question arises, how exactly are these tech giants turning AI innovation into real revenue? This slide breaks down the various monetization models that big tech is using to capitalize on AI and why their strategies signal that AI is not just a side project. It's central to their business futures. Starting with OpenAI, the company behind ChatGPT and other AI breakthroughs, its business model revolves around premium subscriptions and API licensing. This means users pay monthly fees for enhanced access to AI tools, while developers and enterprises license OpenAI's powerful models to build their own AI applications. This approach creates recurring revenue streams and ties OpenAI's success directly to widespread adoption. Google integrates AI deeply into its core products and services. AI powers search enhancements, making results smarter and more personalized, which keeps users coming back and drives ad revenue. In addition, AI is woven into workspace productivity tools, such as Google Docs and Sheets, enhancing user efficiency and encouraging more paid subscriptions. Google Cloud also offers AI tools and services, expanding revenue from enterprise customers. Even YouTube leverages AI to recommend content and target ads more effectively. Microsoft's AI monetization centers on Copilot as a service. AI assistants embedded in Microsoft 365 apps like Word, Excel, and Outlook. Businesses are willing to pay a premium for these productivity boosts. Microsoft's Azure AI stack also serves developers and enterprises, offering customizable AI infrastructure on a subscription basis. This AI as a service model blends product innovation with cloud economics, scaling well across industries. Meta monetizes AI primarily through advertising. AI-driven ad targeting improves relevance and engagement, especially for small and medium businesses, SMBs, who rely on efficient ad spending. By integrating AI across Facebook, Instagram, and WhatsApp, Meta maximizes ad revenue while enhancing user experience. Their AI also helps moderate content and optimize platform performance. Amazon AWS takes a different angle, focusing on AI infrastructure and developer tools, essentially selling the shovels in the AI gold rush. AWS provides scalable compute power, AI frameworks, and APIs for startups and enterprises building AI applications. Though AWS's AI performance has raised concerns recently, it remains a vital player in AI monetization through cloud services. The big takeaway is that AI is no longer just a costly experiment. It has evolved into a core business driver with diverse monetization streams. From subscriptions and cloud services to advertising and API licensing, these models are building sustainable revenue that will support continued innovation and growth. This slide also sets the foundation for the growing arms race and intense competition to own the AI stack, from infrastructure to software to end-user experiences. As we've seen, big tech's AI investments are paying off, but the race is far from over. This slide explores the immense pressure on companies to keep spending aggressively or risk losing relevance in a market moving at lightning speed. The phrase FOMO 2.0, fear of missing out, perfectly captures this urgency. Top executives at Google and Meta have openly stated that it's better to overspend now than miss the moment entirely. They warn that failure to invest enough in AI could mean losing out on the next 10 to 15 years of innovation, growth, and market leadership. This mentality drives unprecedented capital expenditures and talent acquisition efforts, even as companies deal with soaring costs. OpenAI, despite its rapid growth and popularity, remains deeply unprofitable. With a forecasted $12 billion in revenue, OpenAI is still projected to spend $28 billion, losing roughly 2.25 for every $1 earned. To continue scaling and innovating, OpenAI is seeking an additional $40 billion in funding, a staggering sum that underscores how expensive cutting-edge AI development has become. Amazon AWS, by contrast, is showing signs of struggle. Analysts have voiced concerns about AWS's underwhelming AI performance, suggesting it may be falling behind competitors. For a company that once dominated cloud infrastructure, this raises serious questions about whether it can maintain its edge in the AI arms race. This slide highlights a critical truth. The cost to compete in AI is skyrocketing. Companies must spend billions annually on infrastructure, data centers, talent, and R&D. The stakes are high, and the risk of falling behind is real. Unlike past technology waves, AI is moving so fast and requires such scale that only the biggest players can afford to stay in the game. The overall message is clear. In AI, it's invest or get left behind. This has led to an arms race mentality, where companies are willing to take massive financial risks now to lock in leadership later. The FOMO 2.0 effect is reshaping tech strategy and capital allocation decisions worldwide. As we reach the final slide, the question becomes clear. Who can realistically compete in this AI arms race? And who risks being left behind? The answer revolves around the astronomical costs and scale required to remain relevant in AI. In 2025 alone, the combined capital expenditures of Google, Meta, Microsoft, and Amazon are expected to exceed $350 billion. This figure is staggering and is projected to rise above $400 billion in 2026. Such investments go toward building and expanding data centers, purchasing cutting-edge hardware like GPUs and specialized AI chips, acquiring top AI talent, and funding ongoing research and development. This skyrocketing entry cost creates a high barrier for newcomers and even smaller tech firms. To be competitive, late entrants often need to raise $10 billion or more just to build basic AI infrastructure. This makes AI a game with very few players. The rich in compute resources get richer, and smaller or less capitalized companies struggle to catch up. The current environment is increasingly a winner-takes-most market, where scale, data, and compute power are king. The companies able to sustain enormous spending and execute at a massive scale. Google, Microsoft, Meta, Amazon, and some key players like OpenAI are consolidating their dominance. For investors and industry watchers, this dynamic is crucial. It means that betting on AI isn't just about backing the best algorithms or software. It's about backing the firms with the resources to build and maintain the most powerful AI platforms and ecosystems. This slide closes the story of AI's transition from hype to high stakes. The gold rush is on, the investments are monumental, and the battle for AI supremacy has only just begun. The future belongs to those who can sustain the scale, vision, and resources to dominate the AI landscape over the coming decade.